Oh, they paid you. Oh my gosh. Well, I hope they get their money. I hope they didn't pay a lot. Here I am lifting off with butterflies and iron condor. Oh, see, now I think we have almost all the continents. We have Europe, we have South America. Anyway, like Don said, I was a market maker for 15 years. I have my own trading firm. Went to work with Mark Sebastian about 5 years ago when I noticed he was using a training program that I had used at Group Unlimited, which is the VIX CPM. Like, oh, so Mark's idea was to take market maker technique, which basically means you just get a lot of option trades you don't want to do, and you got to make them work, and translate that to the retail environment. I thought that was a good idea. Since then, we launched our own fund, Carbon Line Capital, so it's been pretty good. So I manage just for that, as well as I run our chat room, and a lot of our education and option trade. And every once in a while, when Mark is gone, I do these webinars. Don gave me a call, and I said, certainly. So this is one we're going to do. First, we'll talk about the VIX a little bit. Mark said he touched on right before the election. So there's been an interesting development, I think. And then we'll talk basics of flies and condors. George says the sound is bad, but I'm going to let Don handle that. Hopefully he thinks the sound is good. That, I got to hit the right button. Okay. Today, what are we going to cover? Also, sometimes if you log in and log out, oh, the volume's fluctuating. Anyway, Don, it looks like there's a lot of sound issues for some reason, which I don't have an answer for. I can hold on for a second if you want to keep going. Oh, Michael B says keep going. It's on our side. Okay, I'm going to try to. Oh, yes. Okay, got it. That. How is it now? I just went off and went back on. Hopefully that will work. Martha says the sound is okay, so we're gonna keep rolling. Hopefully it's okay and the recording is okay. So we'll do pre-Trump VIX and post-Trump VIX. Trying to be apolitical, I just look at where the volatility goes. That's all. What's an iron butterfly and an iron condor? They're similar trades, but they're very different. So I'll teach you a little bit about position focus. What makes them fly, which is the title of our slide deck, and then what makes them crash. And with that, we'll move on. And I believe I have a little pin too. Okay. As we recall, prior to the U.S. election, remember we had some volatility? It sounds like a lot. Doesn't it feel like forever ago when we had 20 volatility in the VIX? It feels like that for me because it's a lot less fun to sell when it's as low as it is. However, we had a very jittery VIX prior to the election, and the market did not know what to expect essentially. I thought the way it was playing out looked like everybody knew what to expect with Hillary, and they didn't know what to expect with Trump, and we had some volatility. And now we have now. So let's just take a look real quick. So this is I like this. If you don't have access to VIX future data or anything like that, this is just a free website, just for closing prices, things like that. But it just shows the VIX futures at any time in history, so it's handy. And I want you to look at the election. I have a pen here, which I will use. Wow, look at this. That's right. Okay. So we had this is the VIX future close before the election into the election cycle. And I want you to notice the 240-day future in VIX at that time was trading 1965. So what I would say is this is kind of a normal VIX. We trade a lot of VIX in our fund, mostly VIX. And I would say this looks about normal. You had 16, you had about 3 handles, all right, 3 points of difference in volatility between the short end of the curve and the long end of the curve. And that's just reflective of the fact that volatility in general prices higher in the long term because it's a function of time, and the more time there is, the more things can go wrong. So this was just before the election when everybody's a little jittery. Okay, now we fast forward, okay, to January expiration of 2017. VIX is a couple points lower, right? 1475, the near-term future. But you guys notice how the back month future, the 240-day future, was around the same price, the 19 hand. You guys see that? So we had lower vol in the front. Right? Election's over. Lots of fun. This is right around inauguration. Lots of good feelings. Vol got a lot lower on the front, but you notice how the long-term future was very expensive. If you can say, yes, I noticed that, or no, I don't notice that, or I don't know what the heck you're talking about, any of those things are okay. But again, the one thing about trading options to me is I'm always looking to price the same thing, meaning if I have a 10-point spread, what can I sell it for? So it's always a 10-point spread. What matters is what price I can get for it. So when I'm looking at vol futures, or when I'm looking at trades in long term, what matters is there will always be a 240-day future. What I care about is how much I have to pay for it. So right now, 1995, right before the election, there's a lot of uncertainty. It was the same price. And now let's look at today. Keep this one fresh in your mind. Okay. We have VIX trading at 1084. That near-term future is 1242, but they've taken the back month all the way down to 1628. The October is actually below 16. These are numbers I can't remember seeing this far out in time as long as I've been trading VIX option contracts. So the market has repriced long-term vol by a pretty large amount, I would say. So if the future only about $1.50 away, we're seeing a $3 cheaper future in the back. So for relative future moves, that's a lot. So when Mark was talking about Trump rally and repatriation and all that kind of stuff, it appears that some of that might be coming to fruition, and they took the volatility out of December future. I mean, remember, VIX was 16, what, a week and a half ago, a week ago, and they've taken this future down to 1628. This is a very low expectation. Like I said, about as low as I've seen it. So just some observations from this, from the first 100 days. VIX cash trading multi-year lows. Realized volatility is at, I would say, the last 6 months, probably the lowest period of realized vol in history that we've recorded realized vol. If it's not the lowest, it's got to be the second lowest. We had the lowest stretch of low volatility. Long-term futures, again, at multi-year lows. The term structure is what we call very flat. That means the future from the front to the future to the back. There's not a big difference in price there. Our future vol expectations are super low. Right? So for me, what does that mean? Options level bull market. Why? Because stocks go up. I mean, you're looking at some after-hours earnings the last week. They look pretty good. So you have relatively low volatility with upside potential. Probably after you see this webinar, a tougher time for the type of trades that we're looking at, and see why. But mostly, to me, I mostly like to own gamma in markets like this. Although we're going to talk about condors and butterflies, maybe this will help you be more picky about what you're choosing. Anyway, the base conclusion is the market got used to whatever the new president was doing in a hurry. Also, the vote in the Eurozone pushed vol expectations in the long term remarkably lower. Europe has always been kind of one of those, is Eurozone going to break up? Is it not? At least for right now, the volatility is saying no. So what we could have is a summer of pretty low vol. Anything could happen. Events could happen all the time. But at least for right now, You don't see the bid for vol. Even in 2008 and when things were getting bad in the financial crisis, even before, there was all those little things that were happening started pushing vol up. And right now we're not seeing it. We're getting the opposite. We're seeing vol getting crushed. We're seeing it getting crushed in a long-term way. So what does that mean for us? Well, if we're going to be iron butterfly traders or we're going to sell options, there's certain things that I look for, and that's what we're going to discuss. What do you look for in an iron butterfly or an iron condor, which is essentially it's the same trade, you just move the strikes apart. So iron butterflies, it's just a straddle that is hedged. So anytime I price an iron butterfly, the first thing I think about is what's going to happen at the end of the straddle. So as a liquidity provider, that was one of the first things that I learned. I learned about what the value of a straddle was and what was going on. Oh, question. Low VIX. VIX went down more today, but put call ratios and skew went up. How is that calculated compared? So one thing about VIX cash is what is it measured? Generally, the lower VIX goes, the more skew increases. I'm actually going to do a little drawing on that, and that might help. Okay, in about 5 minutes or so. Okay. So when you price an iron butterfly, you're pricing. I think almost always the first thing you think about is the straddle, what you're selling, and then you hedge, because I'm a believer in hedging, trying to survive trading options for 25 years. You're buying strangles around it, something to kind of create a yield area. I mean, I'm going to sell the stuff in the middle, I'm going to buy the stuff on the wings, and if everything works out, I should make some money. What happens is you get something that looks like this, right? This is what everybody views as sort of your expiration graph. Okay. At Option Pit, one of the rules we have is we don't let people wait to close until you get to this thing. Right? Because if you take any trading platform, you go into your trading platform and you put in a trade, you put in a butterfly where you buy this one, you sell this one, you sell the 105s, you buy the 110s. Will all of them not show the exact same expiration graph? That's a question. Will they all show the same thing? Right? So is there anything special in the fact that you can buy this call, sell this put, buy this put, and get the same risk profile? Right? There's nothing special about that. So this little graph is just showing you as time goes on, you move up the top of your pyramid, basically meaning the options at the money decay at some rate. So if everything goes well, you should make some money as long as you stay within what? This little risk tent. Somewhere between your short strike on the upside and your short strike on the downside. That's a typical iron butterfly strategy. The only reason you buy the wings is so if you wake up one morning and something goofy happens, like the election's one thing, if you're overly short into the election, you didn't have any cover on the upside, it would have blown you right out of the water because it was kind of a big surprise, at least the result was. So an iron butterfly, it's essentially your trade, right? You're short the straddle and you're long the wings. So something has to happen to make you money. This is the important part. So if you have a trade like that, you're not betting on necessarily a direction per se. What you're betting on is a range. So if you're used to just trading, I think a stock's going up, I think a stock's going down, this is sort of not that, it's not that strategy. You're looking for something else. Basically what happens is your long out of the money put will have a higher delta, meaning delta is the sensitivity to a change in the underlying price. So when you sell an iron butterfly, meaning you sell the straddle and buy the wings, it's almost always going to be short delta because the put you buy has a higher delta than the call you buy. Okay, you'll almost always be short delta, and that will be caused by the skew in the options, which I'll draw a little picture here. Okay. So from a Greek profile point of view, because the shorts are closer to the money than the longs, it is long a lot of theta, meaning I'm selling at the money straddles. Essentially, I expect them to decay. That decay is called theta. So one of the things about Greek risk in general, if you have to say, what are some of the assumptions when if I ask you a question, what is one of the assumptions about a Greek risk profile that you have? Would you say that everything stays the same or that everything changes? Not a lot of answers so far. I'll give you a hint. The assumptions with the Greek risk you see is that everything stays the same. Okay. Oh, you couldn't hear the question? Well, that's no good. All right, everything stays the same. Good job, Kim. All right, skew. So if I draw this picture, right, let me use my pen. Okay. What this means is, right, you're buying this put here, you're selling this put, you're selling this call, and you're buying this call. Right? So the volatility here, let's say, is 50. Okay. You're selling at the money, let's say, is 30 volatility, or you're at the money straddle. Okay. And then you're buying a 20 volatility for this call. Okay. So the fact that you're buying 20 volatility and buying 50 volatility, that means the put is going to be more sensitive at the higher volatility. So overall, even though you're selling a straddle and you're buying a put and a call on the outside, so you're selling one put spread and selling one call spread, you're going to be net short if you're selling the at the money. So the question with the skew was, how can VIX go down but the skew go up? Now what happens, can I erase all this stuff? Let's see here. Oh, clear page. Oh, look at that. I love this thing. All right. Now with skew, when he was just asking about VIX, what happens is that's the at the money volatility going down. So what happens is your at the money volatility goes down like this. Right? The problem is the volatility in these downside puts, they don't want to go down. So what happens is the curve steepens like this. Right? The calls don't really like to go down either. So what happens is you can have the at the money vol go down, but the skew actually kicks up. And that's how you can get a lower VIX, but a higher skew. Now, think about it this way. If you're a butterfly trader and you buy these options, but you sell the at the money, don't you think that would be in your favor? Think about it. Your puts don't change much. Your calls don't change much, but your at the money volatility declines. So, Mike, your question goes, would that be, is what happened today ideal for a short-term butterfly trade? If your head just swam on that, I would say the answer is yes. Right? Ideal. Because when you think about the risk chart of the butterfly, the market went up a little, went down a little bit, nothing happened. Okay? All that happened was you had a decline near the money, and all the skew kicked up, meaning the volatility went from, it actually didn't move. It's just this fall at the money came down. So when you're looking at index volatility, this curve is very liquid, meaning it moves around. It moves around from the put to the at the money. The at the money can move, and the at the money can move to the call. When I look at flies and things like that, pretty much all I care about is where all these relative balls are trading. Not quite for this class, but I'm just letting you know that's how things move. What we want to do is just do some simple stuff and talk about volatility. So what you want, hopefully that answers your question about VIX. So anytime you sell anything, okay, if you sell options, do you want the underlying to move? The answer is no. You almost can't get the underlying to not move enough. So that, from a Greek point of view, is short gamma. Anytime you're short gamma, you do not want the underlying to move. You want to stay in the tight range. Okay? You're also net selling option premium, meaning you're taking in a credit to sell stuff. That is short vega. So what you have is a collection of Greeks. Okay? And if I go back, I'm short deltas, I'm short vegas, I'm short gammas, and I'm long theta. Now, if I look at an iron condor, it's the same. So Don asked, iron butterfly or iron condor. How do you create or increase gamma? So how do you get more short gamma or more long gamma? So the simple answer I would say, Rick, is you just do more at the money. You either sell less contracts at the money or you buy more contracts at the money. That will change your gamma fastest. You can change your gamma a little bit by buying options out of the money, but they only give you gamma for so long. Okay. So what we're going to do here, we're actually going to do a little gamma comparison with strikes. That will be my big to-do here at the end. So an iron condor is just a strangle that is hedged. So remember, we said an iron butterfly, you sell a straddle. So in your mind, you're keyed on the straddle. I want that thing to collapse, right? I want it to lose value. An iron condor is different. Same idea, though. I want my strangle to collapse. My out-of-the-money call and my out-of-the-money put, I want it to collapse. I'm going to hedge it by buying an even more out-of-the-money call. Right? All the problems with skew that I described before are the same with an iron condor. Okay, it doesn't go away. Meaning you're almost always going to be short delta. But you have the same landing, what we call a landing pad of safety, is here. Here's an iron condor. Now the graph looks a little different because you notice you don't have the little witchy hat point for risk at the top. You have more of a, I call it la zona impacta, right? The impact zone. Right? My first grade Spanish notwithstanding, what you care about is anything, right? This is your short strike. This is your long strike. I'm short to 45s, long to 40s. Here I'm short to 50s, long to 55s. I need it to stay in here. Now the same thing with is as time goes on, your curve kind of looks like this. You sort of keep getting closer every day. Drip, 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 drip. Hopefully the stock underlying doesn't move too much, and you slowly will make money. Okay? As long as what? You don't move here and you don't move here too fast. So just like an iron butterfly, the iron condor is very similar, except your short strikes are farther away from it, which is the hint. So as an iron butterfly, I like to do stuff that repeats, helps people remember, right? You are generally going to have short calls closer to the at the money than the puts. It's caused by skew, the same thing. Right? Same factors, which will give you a short delta. So if you create an equidistant iron condor like the one I had before, right? 45, 50, 55, 40. Right? It's a 5-handle iron condor each way. This is going to be short delta. Right? If your at the money is 47.5. Because your shorts are closer to the money than the longs, you're going to be long theta, meaning it's decaying in your favor. Okay? You still want the underlying to stay in a tight range, so you're short gamma. And since you're selling option premium, you're short vega. So very, very similar Greek risk profile to your iron butterfly. Okay? So here you go. This is what you have. So one thing I say at Option Pit when I'm trying to teach either professional, we've taught guys that have become floor traders, or guys just day trading or whatever. One thing you've got this: your short deltas, your short gamma, your short vega, and your long theta. These are all the Greeks you have here. So the saying I use is you have to love the Greek you have, meaning your position short delta whether you like it or not, your short gamma whether you like it, your short vega whether you like it or not. Your position is decaying positively as long as the inputs stay the same. Right? You have this position if this is what you do. It's not just enough that you sell it and you hope that things are going to just all decay away and go to zero. Right? It's just not that easy. You have Greeks, you have Greek risks you're going to have to manage, and you have to understand how it works. Right? So, if you focus on the differences, this is what's important, right? They share similar characteristics, but they're not the same. And the reason being, your Greeks change with respect to model inputs because you're using different strikes, you're using different terms, you're using things that change your risk profile. So if you trade an at-the-money option, it's going to have a slightly different risk profile than an out-of-the-money option. Right? You've got to want those risks that you take. You're choosing them for certain reasons. Okay, so why do we do that? Right? Here you go. Keys to success. I can't stress this enough. You want to be good at trading iron butterflies and iron condors, you just do this. Right? Just remember this slide. Iron butterflies and iron condors will perform well when your implied volatility is falling. They're not a good sale when implied volatility is climbing generally. Be fine with selling into falling implied volatility. I believe volatility generally trends after watching you trade for a while. Selling an iron condor or an iron butterfly when implied volatility is rising is sort of like buying a stock that's going down. You're trying to catch a falling knife, and you really don't want to do that. Implied volatility is the same way. It's a lot easier to wait till it stops going up. Then you assess. Right? So, two pictures for you to think about. One is theta. Think of an ice cube melting in the sun. So if you put a position on, it has positive theta. You're going to get decay in a melting in the sun type of fashion. Okay. Also, on the flip side, okay, but theta doesn't really move fast; it moves slow. Vega can move very fast, meaning your sensitivity to a change in implied volatility of your option. Anytime you trade an option, you have one, no matter whether you think you do or not, you do. Sometimes it's big, sometimes it's small. But notice how there's just this image of the dam rushing over the side. It can be hugely big. So if, like I said before, you want implied volatility going down, you're short Vega. If you're short anything you want it to go down, you want to look for opportunities where volatility can go down. That will make the Vega part of your position pay. Because if you sell an option, would you rather be out of it in a day or wait 3 months? Most of us would say 1 day would be fine or 1 week would be fine. I don't necessarily want the risk for 3 months. So you're looking for opportunities where the Vega of the position can move relatively fast. Now let's look at, okay, this is not a recommendation for a trade. It's probably the cues after Amazon and Google earnings have already blown up through all these strikes. Okay, this is just a demonstration of Greeks. Okay, so this is how I teach people to look at things. So I have an iron butterfly. Right? This would be the Q May 05 133 5.5 7.5 fly, meaning I sell the 3.5 put. I'm sorry, I buy the 3.5 put. I sell the 3.5 5.5 call. I sell the 5.5 put, and I buy the 7.5 call. I get a $1.33 credit on a $2 spread, so I'm risking 67 cents. Okay. Here's my risk profile. I've got my delta of -4. So that means for every dollar move in the underlying up, I'm going to lose $4. Okay, you're saying, wow, Andrew, this is a giant position. But remember, everything's relative. So, because you can always scale to 100, right? But I only put 1 lots on because if I put 100 lots on, then people go do that and it becomes problematic. So you're short 14 gammas, meaning every time the underlying moves 1 point, my delta is going to move by 14. Vega, I'm short 6, meaning every time my volatility goes down 1 point, I'm going to make $6. If volatility goes up a point, I'm going to lose $6. And every day where nothing happens, I'm going to make $3. So the one thing about Greek risk you learn is which is the dominant Greek here. So if I had to ask you, is the delta more dominant? Is the gamma more dominant? Is the vega more dominant? Is the theta more dominant? What's the one, if you had to guess, is the one you have to be concerned about? The bigger number, this one. Okay? Because the way this is set up is if you start moving, right, all of a sudden, if you start to tick down, you're going to get longer delta faster because your gamma is negative, and your daily decay is not going to be able to pay for it. So gamma is the dominant factor when you put an iron butterfly. So you need to really keep within that range and support, or something has to happen in order for you to collect your dollars. Now, we have an iron condor, same product in the Qs, and we're selling the 22.27 put spread, pretty far out of the money. I think we'll be close one. Q's close 135.5 or something like that. And your call spread is 41.46. Net, I'm picking up 49 cents on a $5 difference in strikes. So I'm basically, I'm looking for 10% on total risk, maybe a little better than that. I'm risking $4.51 to make 49 cents. Okay? But as an example, notice delta is the same as your iron butterfly. Your gamma, though, is a fraction of it. It's about 60% less. Your vega is much higher in this position. You're short 12 over what, the 6 or 7 that we had before, but you're only making $1 a day, meaning this position is just bleeding along, making you money. So here, notice the vega is a slightly bigger Greek as far as what's going to contribute to your P&L. Okay. So when you look at this, you look at the two. So one of the things, if you're going to start to trade volatility, so if you didn't get the hint about this, mostly we trade volatility options, is what is the thing I have to worry about? So if you think the market's going to move a lot, you don't want to sell again. Right? The iron butterfly is a tough sled. Right? If you think volatility in the farther term is really going to blow up, or it is blowing up, you don't want to sell Vega. If you think the implied volatility is a little overvalued and the market's not going to do much, kind of like today, going into earnings, let's say if you had a one-day butterfly, they're going to crush it. So then you want that type of position. If the implied volatility was really high and it looks like it's dropping, maybe you want to sell an iron condor farther out in term because you're focusing more on the vega and a little less so on the gamma. So here's our tip, right? By choosing what part of vol you want to sell, it helps you determine the risk in the position you want. So if you're going to trade a condor or a fly, you're trading vol. If you're trading vol, you have to pick the right direction. Because that's what your position is going to do whether you want it to or not. Okay. So the difference in gamma and vega are really the two for these positions. Iron condors, to me, are always more vega oriented, and fly on a basic level is more gamma oriented. One is more aggressive, so you can be more aggressive. Short-term stuff generally flies. Longer-term stuff generally iron condors. So for the same type of position, your gamma on a fly tends to be more short. Your vega on the iron condor tends to be more short vega. Meaning, like I showed you before, the more contracts you pile on in the far term, you should be short more vega. The more contracts you pile on in the near term for an iron butterfly, you're going to be short a lot more. Okay? One, you're selling the market moving, or kind of the realized vol of the market. One, you're selling the implied volatility. And after I just showed you the slides for where relative, let's say VIX, if you use VIX as a relative level, you're probably picking, historically, at least for the last 5 years, the lowest vol if you're a Vegas, which is tough because you're basically selling stuff at the bottom. Okay? So here's a couple more hints. Trader wants your realized vol to be falling as well as your implied. What is HV? HV is just the underlying volatility of your product. It could be Qs, it could be SPY, it could be whatever. It's what was the vol of the last 10 days? That's 10-day realized vol. How much is it moving close to close? So you want that number to be declining. So if the market was just moving a lot and now it's moving less, you have declining realized vol. That is ideal for these positions. I can't tell you how much. The market not doing much is great for these positions. One of the reasons you don't sell really high implied vol is because the realized vol is so high. Meaning, because you're short gamma, you don't want the stock or the underlying, you don't want the SPY gapping up $4 every day. It's hard to make money selling anything that way. So you're looking for the stock or the underlying to stop moving and slow down. So if you're going to trade these things, you want to trade them into a decline, not a rise. Okay? It helps you be a little more consistent. Okay? When your fly is a no-go, you don't want to sell an iron butterfly in a higher realized vol, meaning stock's moving a lot, the market's moving a lot, fly volatility is going up. You'll be right outside of that risk tent that I showed you earlier, and you're not going to be happy. Okay? So this is a trick that I use. Is what I want is I want to take a look at your at-the-money straddle value. Okay? And if it keeps expanding in value, you want to wait. You want to watch it stop expanding and actually start contracting before you even think about a trade like this. Because if it keeps expanding, you'll never make money selling around. You just won't. Anything you sell for $1.75, it'll be worth $2 an hour. Okay, so you want the easiest way. Watch the at-the-money straddle, and it needs to stop expanding. Then you think about it. Okay. So last couple things here as we roll into the end. You don't want your delta to become a risk factor in your iron butterfly. So remember, you have a slight short delta, but you're really looking for the implied volatility to drop. You're looking for a buildup in theta, something. You don't want to have a delta. That's the whole point. Now, sometimes you can hedge with a call or put. That would be for another session or something like that. But you don't want that. So as soon as you have a lot of deltas in one of those trades, you either have to have a hedging routine or you're closing, because you don't want it to be a mess. Second, normally what you look at, you'll hear that theta is something you're going to get every day. Your positions don't decay as long as implied volatility is increasing. Because you sold an option this morning or iron butterfly for $1.75, implied volatility goes up, now it's worth $1.95. There's no way anything's going to decay as long as something moves from 175 to 195. The only thing that has happened is you're 1 day close to expiration, so you need that IV to stop going up at some point, or for the underlying to stop moving to have all those dollars come. Last thing here, when implied vol explodes, your vega can still be a problem, as the fly will not collect any theta, like I just said. But you still have to deal with the gamma part, meaning you're ripping outside of your tent. So, if the market's moving too much, it's not good. So in a lot of ways, lower volatility means you try to keep your duration shorter for almost anything you do because the market's not moving as much. Okay, here's your last thing, or one of the last things here as we get to the end. I think the biggest decision is trade-off and duration. I like flies for short duration, especially when the realized market in vol is so low. We've got dailies and weeklies. Those trades start to look a lot more appetizing. Um, I like iron condors when you have higher implied volatility overall, and you can get a little farther away from the money. That gives you a little more cushion if the market starts moving a bit, right? And those are really how I think about stuff. You've got to think about duration and what's going to happen with implied volatility, and that really gives those types of trades the best chance of success. Uh, in general, I like them more in the indexes over equities. Some equities it could work on specific events, but they are pretty hard unless you're good at it to trade flies or condors in equities. Some people can do it well, but it's not easy just because an equity can do almost anything any day. It's tougher for the broader indexes to do that. Okay. So I just threw a ton of stuff at you at once in 35 minutes. Iron butterflies and iron condors, they take some work, but you've got to understand what the IV is doing to make them work. If you don't, forget it. It'll be very hard to make any money. If you control the gamut and learn how to hedge, create positions that are easily hedgeable with one or two contracts, it's a different story. Obviously, I didn't have time to go into hedging strategies and stuff like that, but you can use VIX, you can use index calls or puts to sort of direct your hedging routine if you want. I think the most important thing is just learning how to sell into declining realized vol. That will give you much better chance of success. And there you go. Thanks for attending.